Welcome back to another episode of the Merging Life and Money Show. I am your host, MarieJo Caesar. Today, I'm thrilled to introduce our special guest, Steve Selengut. Steve is a #1 best-selling author of Retirement Money Secrets. He is an investment advisor with over 40 years of experience. He's managed more than 300 different portfolios at a time, both domestic and abroad. Throughout his impressive career, Steve has developed a unique approach to creating retirement income independence. He focuses on generating reliable income without selling hard-earned investment to pay the bill, a strategy that works whether the stock market is going up or down. Today, Steve coaches individuals and professionals in creating retirement income independence. His philosophy shifts the focus from chasing market value returns to creating a consistent stream of spending money. Steve, welcome to the show. It is such a pleasure to have you join us today to share your expertise and insight with our audience.
Thank you, MarieJo. I'll do the best I can.
No, don't worry. It's all about conversation here, about empowering and educating our
Mhm.
audience. So many of our listeners are either planning for retirement or already in retirement. They are constantly bombarded with conflicting financial advice. What they are really seeking, in my opinion, is financial security and peace of mind. So before we dive into our conversation, I'd love to start with understanding the foundation of your approach. Your work emphasizes income independence rather than the traditional focus on accumulating wealth. Can you explain what the goal of income independence really is and why it is so critical for retirees?
Yeah, I can do that. I've always been an income focused person. Growing up, my dad had a vertically integrated real estate development company,
Mhm.
meaning that not only did he build houses, he owned the property, he would finance the homes for people, he would insure them. He had a lumber yard that had all the materials that his subcontractors would need to build the homes and so on. So he had many different streams of income. And he always emphasized to my brother and I how important that was, that the economy changes. Sometimes you can't sell houses, but if you have houses that you are renting to people, they're going to continue to pay the rent.
Mhm.
You just can't sell new houses, or you're still going to get, there's still people who own houses are still going to pay their mortgages and they're going to pay their insurance premiums. So even if you can't sell a house through a recession that lasts 18 months, you still have the money coming in. I apologize for that.
No problem.
It's my wife telling me she's on her way home from shopping.
That's, well, at least you know where she is.
I
She's
do.
letting you know that she spent your money, so she's on the way.
My money? It's all her money.
Okay.
Hey, when you've been married 55 years, you understand that. It's
Yes,
her
dear.
money.
Yes, dear.
So back to so income. Growing up, income was always important to me, and it was almost like he was telling us, even when we got educated, when we went to college, and all this stuff, you got to have more than one source of income. So what I did, and I was fortunate, I was quote privileged, however you want to say it. I'm one of those guys. I had the wherewithal to get started investing when I was younger. I was 25 back in 1970, and that's when I first got my hands on the money that had come from all various sources that wound up in my hands. And I had a portfolio pretty much of income producing stocks, and I learned how they worked and stuff like that. And I liked the idea that while I was working in New York, commuting to New York with my three-piece suit on and all that routine and not making a whole lot of money, that I had this side income coming in. And that side income, even in those days, even back in 1970, was enough that my wife and I could take somewhat for us. We could go to Florida for the winter for a couple weeks in the winter, stuff like that. We were able to do more than just what I could have done just from my salary. My objective in life became I'm going to build this program, this side hustle, if you will, to the point where I don't have to commute to New York anymore, where I don't have to put up with not only the hour and sometimes 2 hour commute, but I don't have to put up with all the baloney that goes into a relationship in a huge corporation with so many levels of management that you have to deal with.
So this was in the 70s.
Yeah, yeah.
Okay.
From 1970 to 1979, I developed an investment process where I would not only accumulate just income producing securities, but I'd also trade them for target profits all the time.
One thing I could tell you, you did say that you were fortunate and privileged that you were, because I know that the average American, doesn't matter, white, black, polka dot, purple, whatever, did not have that as at 25. That knowledge and being able to execute on that
I,
knowledge.
I didn't get the knowledge myself. The concept, yes, but the knowledge of the stock market stuff, interestingly, and you'll find this interesting for that era, my broker was a woman, and there weren't a whole lot of women in the field
Yeah.
back
Yeah.
in 1970. And she was pretty maternal in the way she treated me. I was probably 20 years younger than she was or more. And she told me, what are these entities? What's a stock? What's a bond? What are these things? And she explained more as much as my courses in college did. She gave me more. We talked about the fluctuations in prices and how there was a market cycle out there and it all went up and down. And we developed a list of all the ones that paid dividends.
That's great. And I'm happy to know that back then there were a woman in that financial space, which, believe it or not, decades later, we are still struggling to have
Oh, absolutely.
women, and particularly women of color, in that space, and being able to educate and empower younger generation about the whole power of personal finance. So
Right.
let's move on to the discussion of the day. Could you walk
Okay.
us through the four great financial risk minimizers you've identified? Why are these specific elements so important for financial security?
Oh, okay. I can do that. There was one other thing I wanted to tell you about Rita,
Okay, go
though.
ahead. Go ahead. Yeah.
And I think the thing that a lot of people don't do this day, Rita and I came up with targeted profit taking. We saw how these things fluctuated and never thought about this one's going to go up forever or whatever. What we thought about is these things go up and down 10% all the time. So if we buy them when they go up to 10% and then get back into them when they go down around 20%, we just keep doing that with the same names and numbers. Will develop a huge sum of money here and a great stream of income because they're all paying dividends. So she put that in my head. So we'll get to why was this an approach that was less risky than normal? And what are those four key elements of investing that protect you from financial risk? And I say financial risk specifically because most people who are dealing with the stock market and Wall Street today, they never hear about financial risk. They only hear about market risk. And every security that's traded, any security that's for sale that you can buy from someone or sell to someone, is subject to market risk. Prices change, but that's their normal state of being. We shouldn't be concerned about that. What we have to be concerned with is financial risk. And the four minimizers that I'm talking about are there to minimize the financial risk. Financial risk is the chance that whoever issues the security you buy, be it a stock or a bond or a mortgage or whatever, it's the risk that entity will go out of business and your investment will be worth nothing.
Okay.
Okay. And everyone should know that bond type investments, income focused investments, are less risky than stocks, equity focused investing. Because if my pizza parlor goes under, all the stock that my family members bought to help me, that goes to zero. But
Mhm.
the loans that the bank has, they don't go to zero.
Yeah.
They don't go to zero. They still may get some money, whatever they can sell my assets for. So financial risk, stocks have the highest financial risk, and we want to minimize that risk. Four ways to do this. And the first one, and is the first one, or what Ford would call job one, is quality. You have to develop a way to identify those securities that are of the highest quality. Now, you'll remember this because back in the day, Standard and Poor's Corporation used to publish what they called the stock guide.
Hmm.
And it was a monthly thing. And every stock that was out there had its own line of information. And you got everything in there, its symbol, its price earnings ratio, debt to equity ratio, all these things, whether or not it paid dividends. And
You are really taking us.
on memory lane, right?
Yeah, since then, Bloomberg has changed the stuff, right? So instead of pulling that book, I remember every morning I would stop at the Bloomberg terminal before stepping into my office and do my check, one of many during the day. Yes, you got to invest in quality stuff. It's no
Right.
question about
So you identify quality by
it. Hmm.
how long it's been in business, how diversified is its operation? Is it like the buggy whip manufacturer who went out of business as soon as the automobile came along? Is it a one show pony or does it have a diversified line? Does it pay you a dividend? Very big quality element. They got to be making money to do that. So things like that. So you develop this set of quality determinants first. Then the next thing you do when you set up your portfolio, you make sure that it's diversified, that you have not anywhere near 5% of your total portfolio in any one security. That's the classic what you get in your economics courses. In my portfolios right now, I don't have any security that has more than 10% of the total portfolio
Yeah.
in one. So I own a lot of different securities, but still in all, that's a significant thing. It's got to be diversified and you diversify your portfolio not only by the number of names, you don't want to have 15 different oil companies. You want to have sector diversification. If you're doing funds or closed end funds like I do, you want to have the management company diversification. You don't want to have all Vanguard funds. You don't want to have all BlackRock closed end funds. You want to
Hmm.
have a variety. So you want to diversify in many different ways. There's global diversification. I want to have my finger in every possible pie there is out there. Okay.
But let's be candid here. For person trying to set up their portfolio, this could be quite, I won't say difficult. I don't really believe in difficulty like this because those things are acquired skills. The point that I'm trying to make here is that asset allocation is key when it comes to the financial risks. You have to be able to spread across, as you said, think about the sector diversification, the global diversification, country diversification. You want to make sure that you are using the most effective,
Right.
efficient
Right.
pieces there.
So diversification pushes the risk out. And when you're just getting started, it's best to use a fund type mechanism where you have a professional
Mhm.
manager and a whole variety inside specific portfolios. And I focus, since I'm income focused, I've found that closed end funds is not only the oldest form of fund that you can invest in, but it's also the one that is mostly focused on providing income to investors because of its structure. It's a pass-through trust, and that's a legally set up trust whom in order not to pay any taxes themselves, they have to give 95% of their earned income, their net income, to their shareholders. So they
Okay.
are an ideal situation because in a small portfolio, these are diversified funds and you can get them broadly like stock market or S&P 500 closed-end fund that focuses on 500 different companies are in there. The average closed-end fund owns over 200 different securities inside. So it's really good for the new startup person, and it's
Yeah.
paying a lot of income. So we've got two of the big four. The next one is income itself.
Yeah.
Income is the next risk minimizer because a business has to be successful to provide income. It has to have your interests more in mind than, let's say, the securities that are the biggest, the FANG stocks on the NASDAQ exchange that are huge companies like Facebook and Amazon and Google and don't pay any dividends to us at all.
Yeah.
So
So, Steve, this is great information, but I want to move on.
we need four legs or the stool's going to fall over.
Well, yeah, all depends how it's balanced.
The other one's an easy one. It all depends on your balance, right? But the fourth one, and this is one most people don't even think about because they fall in love with their securities. The fourth one is profit taking. That's what makes me be smiling right now with the market crashing while other people are pulling their hair out. I take my profits. Took our profits at 10%. With closed-end funds, the maximum we take any profit in a time like right now. So the profits have to be brought to the bottom line. It's like capitalism. You
Okay.
don't go into business to see the value of your inventory grow, right? You
Yep.
run a store. If the value of your inventory is growing, that means you're not making any money. It means you're not taking any profits. So the same thing applies to the stock market in your portfolio. And I'm done with the four.
Yeah. So good. So let's move on. So,
Let's move.
how can an average investor implement these risk minimizers into their current financial strategy? Can they do this without completely overhauling their portfolio?
Not. It's not likely because portfolios today, if you've been doing it on your own, you're probably only in the stock market because you never hear about the bond market or income investing. And you may be all over the place with different companies and everything. And rarely do you pick ones that are paying dividends, unless you happen to get tuned into a podcast or something that talked about dividend investing, then you might know something about that. But most people aren't aware that they can be in the stock market and be earning considerable income at the
Yeah, and
same time.
it's all depend what your objectives are,
Your
and
objectives.
yeah, and what you are investing for. Some people sometimes they want growth. They are not necessarily looking for income at the time.
And who's advising you too is
Yeah, so that's why I always tell people when you talk to your investment advisor, be precise, explain exactly what you're trying to achieve, and they will definitely advise you accordingly. But it's very important to go there with some knowledge so that
absolutely.
you totally understand what they are offering to you. So tell me, which of these four risk minimizers do you find most people tend to overlook or underestimate?
The profit taking is probably the one that is exercised least. Okay.
Mhm.
Quality, most investment advisors, even the model portfolios that investment advisors use today, the quality is not so bad. It's not so bad.
Mhm.
The problems are diversification, where they fall in love with something, where they reinvest in the same things. They dollar cost average and just keep throwing money into the same five companies forever and
Yeah.
ever. They get poorly diversified and they wind up having, I've seen coaching clients with $2 to $3 million in five securities.
Yeah.
And that see the baldness here? This is from pulling my hair out when I see that and trying to explain to people how much financial risk they're taking by not being properly diversified. I'd
Yeah.
say that
Mhm.
not being properly diversified is the most dangerous mistake people make, even more so
Okay.
than quality.
Oh,
Because if they
that's
diversify properly, that's fine.
mhm.
And the proper profit taking, because that's what makes them lose sleep, because they have this big lump of profit and they're afraid that something like what's happening right now is going to happen. And they don't take a moment and take their profits.
You mentioned two. I wanted one.
I know.
Which one of these four
The first, I'd say the most dangerous one
uh,
is
tend to overlook the profit taking? Okay,
yeah.
moving along. How do these risk minimize?
That was a
Sorry.
tough question.
Well, in the process of educating
I know.
people here, and it's a phrase that said, "Oh, we don't really want them to be drinking from a fire hose this morning. We want to be clear enough so that they leave the show with some understanding." So, how do these risk minimizers work differently depending on someone's stage of life? For example, how might they apply differently for someone in their 40s versus someone already in
Hmm.
retirement?
The income measure probably is less important for people under 40 than it is for people over 50. Okay. I do think they're interrelated. It's- I really do. But you're absolutely, it's a great distinction on age and position or even level of wealth. There are two times in your life when you shouldn't take any risk. When you're just getting started, you want to minimize risk because you want to be able to build something initially. You can't afford to take great risk. And when you're wealthy, when you hit that lottery or when you get those big bonuses or land that big job and you've got seven figures going for you, that's when you don't need to take risks. Then is when you want to focus on income and quality and stuff like that. Yeah. So, yes, you're absolutely right. It really is very dependent on where you are in your life voyage.
It's quite interesting because I'm not a gambler, but typically speaking, when I hear people talk about their gambling journey for the gamblers, the more the money comes, the more they keep on gambling, right? If they are lucky enough, they walk away with a profit, but more often than not, they lose everything that they win.
And that's a perfect analogy for the
Yeah,
stock market.
yeah.
That's what most people's experience is in the stock market.
Although, let me say that it's knowledge, understanding, exactly what you mentioned earlier. You develop a knowledge base at an early age thanks to a mentor that you had. I don't think people with a mentor would be in a casino gambling their wealth or having very little to start with and say, okay, I'm going to see if I'm going to get rich with the little bit that I have. Which leads me to the next question. In today's economic climate, with concerns about inflation and market volatility, what we've been experiencing for the past, I would say, 3, 4 days, have you adjusted your thinking about any of those risk minimizers?
One of the things the risk minimizers using them does, it insulates you from these problematic situations that occur from time to time. You already have established your quality of your portfolio. You don't expect your Exxon or your Microsoft or your blah 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 quality things to
Mhm.
really be permanently hurt by temporary situations. We hope they're temporary. Okay.
Well, yeah.
So quality is a protector. That's what risk minimization is all about. Diversification protects you. Income protects you. All of these things protect you. And if you have also applied the profit taking, your losses are really all on paper now.
Yeah.
Okay.
And that's what they have to understand. Your losses are on paper. They are paper losses. They are not
Right
realized
now.
losses right now
And
because we are living in some unprecedented time. I'm not young, okay, and I have been through quite a few of those bumps through the course of my life, knowing what I know about investing. And this particular time that we're living, I don't know if you would agree with me, I have never seen it. What's certain now is the uncertainty that exists because you never know what can happen as we speak. Moving on from these minimizers, you mentioned the department store analogy.
Yeah,
Okay.
there you
You
go.
have a fascinating analogy, I would say, comparing portfolio management to running a department store. Could you explain this comparison and what insights it offers?
It's your portfolio. Think of it. If this is for me personally, my portfolio is what let me bid farewell to this job I had in Manhattan and say, I'm making 5 times what you guys are paying me right here by myself. And I don't even have to wear a sport jacket, much less a three-piece suit to do it, nor do I have to get on a bus and travel for an hour and a half. So why would I be here when I've got this source of income that I can now say, "Oh, I'm going to start making income sources like this for other people. I'm going to start my own company, my own investment company." And that's what I did. So what you are, wherever you are in your employed life, obviously this type of analogy, your portfolio is like it's your side gig, it's your other business, and you're going to want to develop it. You want to develop that department store so that it has all kinds of products on your shelves to sell. And at first, you're going to have just a limited supply because you can't afford all that much inventory.
Yeah,
But
which
as people come in and
Mhm.
buy, in other words, as you sell, take
Uh,
your profits, you increase the size of your inventory, the breadth of your inventory, and all of a sudden, maybe you don't, if you use closed end funds, you don't have a store, a department store, you got a shopping center because you got everything in there and it's always for sale.
so before we move on, you mentioned inventory. So how do you approach inventory management when it comes to investments?
I'm sorry, investment management? Is that
Yeah,
what's
I
the
said, how do
question?
you approach inventory management
Oh, inventory management. I see.
when it comes to investment? You must excuse my French accent.
I I'm sorry.
That's
If
okay. That's okay. I
I
get
might
it
have,
all the
I took 3 years of French in high school, and I practiced a couple times when I've been in France, but I'm certainly not fluent at all. In any event, okay. Inventory management. You don't want to expand. You don't want to have 400 pairs of the same jean size there. You want to have one or two, and you want to have one or two that fits every customer that comes in there. So everybody can shop at your store. And it's the same thing with equities and income focused securities. If you use the fund type that I use, I own 240 different closed end funds. And
time. Wow.
I've got every possible sector, every possible global entity, all the different stocks that you would want will be in the equity closed end funds and all different kinds of bonds and real estate, mortgages and liens, loans, any CLOs, BDG, REITs, everything you can think of are in these packages that we call closed end funds that pay extraordinary income. So that's what's in my store.
Mhm.
And it's all for sale. And I've set a very low markup for it. And sometimes, like today, I'm on sale. You come into my store and you give me 1% profit. I'll take it, Val, because I want to get my cash out because now I can buy inventory even cheaper and add even cheaper inventory to myself. So that's exactly how it works. It's exactly the same as if you were tossing pizza, or if you ran a department store. I've seen people use analogies of how many fishing lines they have out hanging over the pier to catch fish. If you
Mhm.
have two, you got two chances to catch fish. But if you have 200 fishing lines in there, you're going to catch more than two fish. So there's a lot of ways of looking at investing in a practical manner. People approach investing much too emotionally, and they
Well,
make
as they say, money is 80% emotion and 20% practicality.
and if you had another 10%, it would be luck. But
Well, I don't really believe in luck when it comes to my money.
try to I try to separate out that emotional part
Yeah.
because I don't fall in love with these things. I have a target profit, and I don't care if Bloomberg or one of the commentators say, "Oh, this is a $60 stock." If I've already got my 5% profit, I'm going to take it and I'm
Your
going to buy
point
some
was
up.
well taken, but the audience is not as knowledgeable. The average person do not have 200 closed-end funds in their
No,
portfolio.
no.
Okay, that's a fact. Moving on. What metrics do you use to know when to restock? Still talking about your department store analogy. What metrics do you use to know when to restock?
When I sell, okay, when I sell a position profitably, I'll restock and I will buy that position or a similar position again. if it's a healthcare, if it's a healthcare product, I'll replace it with something else in the healthcare industry in my department store. That type of thing.
Okay.
Okay. If I have the see the good thing about my inventory is my inventory pays me a lot of money by being there. It also pays me distributions. So every month, like at the end of the month, we're still at the same prices we are now or lower. I will take that new money and I'll add inventory to where the price has gone down. So now my average inventory for that type of product is lower. So if the prices go up quickly, I'll have a larger profit margin on the whole. But if the profit prices go up slowly,
Mhm.
the last in, first out method, the
Yep.
one that I have, the last one I bought is
Mhm.
now at a 5% profit. I'll sell it and I'll keep the other ones. So that's how, yeah. Do you know that most companies, if you don't specify by lot, they'll always take FIFO? They'll always sell the first in, first out.
Okay. Again, it's based on knowledge.
Everything.
So if you cannot worry about what you don't know. Diversification, you mentioned that a lot, right? So how does this diversification work within this department store framework? Are some departments more important than others?
I would say in practicality, yeah, there are always some products that are more popular than others. I would say if you relate that over to the products that are in the energy sector, they're always a little bit more actively dealt with and bought and sold than the others. The ones that the products that are totally in the bond market are going to rarely be sold. Okay. Not
Mhm.
as frequently as those that are in the stock market part of your inventory. And you have to expect when interest rates start to move up and down, then those bond holdings get pretty exciting too. Because when they're in the form of a closed end fund, you've got that same push button buy and sell capability that you do with a stock in your new fancy brokerage accounts. You know,
Absolutely.
we didn't
Absolutely.
have back in the day. We didn't have push buttons in the '80s. Were you
Yeah,
around? Were you?
we did this, that's
Did
for
you
sure.
experience the '87 crash?
I can, yeah, somewhat.
Not hands on.
Not hands-on, but I was still in the financial space, not
Yeah,
directly involved in trading as yet.
yeah. I was running people's portfolios at that time.
Yeah.
It
Hmm.
was an exciting time. Throwing in orders 5, 6, 7 points below the trade and getting them because it was like a 2 day blitz. So if Pepsi was trading at $35 a share, we'd put an order in at 27.
This
And
this
we
was this was
and
probably the,
somebody and you know how people sell, they throw their hands up, sell, and they sell at the market. And
yeah,
if you
this
become the
was probably
market, and
the
I became the market. And
yeah.
so I was picking stuff off at 5, 6, 7 points below the last trade. It was
Well,
crazy.
they had to shut down.
Yeah, they did.
They had to shut down because this people couldn't take it
Right.
anymore.
They shut
This
it
was
down.
probably the longest day in the market, Black Friday that was.
That's right. My
So
my brother's birthday, October 19th.
really, so
Yes, it was.
When managing a shopping center, right?
Yes.
Tenant selection is critical.
Okay.
So, how does this translate to selecting the right investments for an income focused portfolio?
Very good question. You are pretty good at this.
I have a financial background.
Very good. Very good. Okay. So it gets really back to that quality and income and diversification type
Mhm.
of thing. On my, I don't want people to come into my store and say, that's trash. I want them to say, hey, that's top of the line stuff we've got here. I want to have the best of the best.
Right.
I want them to look inside and see the performance of this and want to buy it. And I
Mhm.
have selected things that have shown their ability to go up and down and operate. Yeah, so in the selection of what goes in the store, it's very important. The quality, that diversified product mix. In my shopping center, I want to have something from every. They can even go to the movies,
Yeah, that's
right? You know, so
yes.
so that's that type of thing. It's you don't want to be focused in just one entity or one sector. You want to have a little bit of each. And even with a smaller portfolio, closed end funds are unlike most other entities. They have a very low trading range. The average the average cost of the funds, I'm just going to look here,
Mhm.
cost of a fund that invests in income securities, and this is over 100 of them, the average cost is less than $12 per share.
Wow.
The highest priced one in the whole universe of things I look at is in the 30s and 40s, the highest prices.
Okay.
The
Okay.
average prices are right down that you can buy 100 shares for some of them for
Two dollars.
$500.
Yeah, yeah,
They're
yeah.
$5 a share. So you can get the diversification you're looking for as a small investor.
And that's why it's important for us to do what we're doing now, which is educating the masses. Because for some people, investment is something that they cannot afford to do, when in essence, it is not. So I'm still really fascinated about this store analogies that you have. And I have one more question, I promise. And the
Okay.
last one. In retail, seasons and trends affect shopping patterns. So, how do market cycles influence your department store's approach to portfolio management?
Oh, you are good. Okay. Let me, okay. The market cycle is not just one number. It's not just one line like we want to look at it. If we look at the Dow Jones or the Nasdaq or S&P, we're looking at one line.
And for the audience which is not educating, these are the various financial markets indices.
But within them, each sector has its own kind of cycle. Okay. Depending on the news, depending on discoveries, depending on all kinds of factors. Like right now, the steel industry securities are probably not as strong as other types of building type materials because of the tariff situation that's going on. Every sector will have its own influencers. So the prices that you're buying your inventory at are going to vary, and you have to be willing to use that cycle to your advantage because you've seen in the past how the price of oil may go up, and therefore those securities will go up in price, but then the price of oil somehow goes down, and then the prices go down for a while. If you are using the market cycle properly, you'll be looking for those events. You'll be watching those price movements. And when the prices are falling, instead of getting excited that the companies are going to go to zero, you get excited in another way, thinking that now this is a bargain and I should be adding to my positions or buying new positions in this sector and
Mhm.
holding them in my inventory for the next for a couple weeks later when the crowds are going to come rushing into the store and once again want oil companies. So
Okay.
that's the type of thing.
Great. I must say that it's really a fascinating concept. Just being able to break it down and explain that a portfolio is a group of investment, basically, that could vary from the basic stocks to the funds, etc., etc. And it all boils down to the four principles that you mentioned, the minimizers, and how you decide to invest. And I will remind the audience that being an investor is like being a scientist. Okay?
Mm.
So do not attempt to do those things without a knowledge base. And if you want to invest effectively, I would urge you to seek advice. Go to a professional because the show is for information purposes only. Okay, we are not giving you any investment advice. Yeah, so remember that. So it's not because Steve said or Mary Jo said that you would go and happily get on your brokerage account and decide to
Well,
purchase
we
whatever you want.
we've been very professional.
Oh,
You'll
totally. Yeah.
you'll find that professionals will almost never discuss individual securities
Yeah.
because they don't want you to think they're recommending anything to you because
Yeah.
everybody's situation is different.
Totally. And we're just looking at the concept of investing.
Right. Okay. And so education, I agree so much.
Mhm.
Education is so, would you just say thin in the financial area in our country
Oh,
or
yeah.
existent?
I won't say that it doesn't exist. You certainly won't go on TikTok to find out how to invest. Okay. Let me say that. Okay. Let me put that out here.
Okay.
So now that we touch on those few things, I want to get into income independence. Could you explain what income independence means in your
Okay.
framework? How does it differ from the conventional focus on total return?
Total return on the cover of my book, Retirement Money Secrets, there's a tagline at the top of it, and it says, income fuels the ego.
Yeah, I'm
All
looking
right.
at
It
it.
says excuse me, it says market value fuels the ego. Income fuels the yacht. So, in other words, income is what gives you the wherewithal to do what you want to do with your life, how you want to spend your money, how you want to help your children, how you want to do whatever you want to do. So, the income focused way of investing puts that center stage. Okay. When you have a portfolio, let's say you have a portfolio of $50,000 and it goes up to $100,000 in market value. Whatever income you were receiving from it, which could be 2% or 3% most often, will not change just because that market value went up, doubled. The income will be exactly the same.
Mhm.
Unless you pull the trigger and sell the securities that are up, take them and invest them in something new that's paying income, you're going to be stuck. You're going to have that beautiful 100% profit staring you in the face, but it's not doing any work for you until you take it and reinvest it. And if you invest, even if you reinvested it in the exact same thing, you'd have that much more of a base position generating income.
Yeah, so that's a very good and clear explanation there. So tell me, what pays the bills in retirement? Market value or realized income? Because I'm wondering why do so many financial advisors tend to focus on market value instead?
Oh, I can tell you that answer, but yeah, you can't spend market value. Okay. Let me put it to you, I can say this in one word. In today's environment, and it's not the fault of your financial advisor, it's the way the industry operates now in a no commission environment. Okay.
Okay.
So in this environment, the only entity that benefits from you having a higher market value is the company that you are investing through. The advisor also benefits because he gets paid based on amount under management, but the company is dictating to him how he operates and what securities you buy from him in order to grow the market value. I'm sorry this sounds like a that I'm slapping these people in the face. I'm really
No,
not.
I mean, that's your opinion.
It,
Again, investing is all about understanding and application.
so
And of course, you cannot forget the dynamics. As I said, when you look at the finance environment today,
yeah,
certainly your decision as an investment advisor would be quite different from what it was before the presidential election in America. Okay, because the dynamics and the logistics were totally different in that
sure.
case.
And if you think about it, my accounts, just like everybody else's, are down in value.
Oh, we don't want to talk. We don't ever want to go down that lane.
Okay. But my accounts are still generating for me over 10%.
Well,
And when in the end of the month, when I get my distributions on the last two, the 31st and the 1st, I get all that money that I can now reinvest at prices that
the,
are significantly lower
oh, yeah.
so I can make my income even higher. Whereas the persons who have just been watching this happen,
Yep.
you know,
Free fall
they
for sure.
still have that same little teeny bit of income from a market value that's pretty teeny itself.
Yeah.
And they're not benefiting from that market cycle change what we talked about with the profit taking and the quality and the
Mhm,
income.
mhm.
That allows you to take advantage of the changes in the market cycle. It lets you take care of all that.
Definitely. So, how can investors make the 4% annual distribution rule work to their advantage
Oh,
while pursuing income independence?
let's give it a little let's give it a little meat, okay?
Okay,
Okay.
yeah, I need to
These
understand.
the stock market is the what would you say? It's the theater for capitalism.
Totally.
Okay. This is where you see what happens because companies are making money by selling products and producing profits or providing services and charging for it that produce profits. Okay. That's what all these companies, all those ones at the top of the list on how high they are and how pricey they are. They only got there because they took profits. And our financial community wants us to buy them because they are so good at taking profits. And they want us to love these companies and keep holding them because they continually make money and they make their prices higher and higher. But the problem is they don't give us anything,
Yeah.
do they?
Which leads me to my next question.
Okay. So,
What's the critical difference between growth in market capital
and
versus working capital? Why
right.
do investors need to understand this?
If you talk to any financial advisor and say, I want to grow my working capital every year, he'd have a blank look on his face. He wouldn't know his working capital is the money you actually invest to add. Here's an illustration for you to add more houses to your monopoly board in
Mhm.
hotels. If you just watch the market value go up, you don't have anything to buy more houses with or more hotels. You got to have those profits.
Yep.
And that's what is missing. He will set you, your advisors will set you up with a portfolio and try to grow market value so that when you retire and you then have to spend 4% of your market value to maintain your lifestyle,
Right.
they plan on taking it by selling securities that you own. And believe me, they don't sell the profitable securities. They sell the losers.
Yep.
So you're losing capital each time they pay you part of that 4%.
Yeah.
So
Hence,
let's say this month, for
uh-huh.
example, the 4% that or the piece of 4% that you're getting as a retiree is coming from sales of losing securities in your portfolio that they have to do that to give you the money. Why can't they design your portfolio to generate not only the 4% you need, but also the point and a half that they're taking in fees. I can show them, I can tell them of 7 different varieties of securities that pay more than 4%. You got closed-end funds, you got some mutual funds, you got plenty of ETFs, you got CLOs or collateralized loan obligations,
Yeah.
BDCs, which are business development corps. You've got REITs, which are real estate investment trusts, and it goes on and on. They just don't want to focus on income producing securities for the simple reason that they do not tend to go up in price as rapidly as stock market investing.
Yeah, and a lot of this could be, I won't say explained. The public, they want money now. Okay? It's no longer invest for the long term. Okay? But for the new generation, even the youngest millennial and the Gen Z, it's about what's happening now. I want to see it now. They don't realize that time is on their side and that it is important to understand those investment concepts. I don't think that must have changed since the 80s when I started to follow investment. It's just the way of thinking. I want it and I want it now. So this can definitely not work. But I totally understand. And while it is, everybody must understand working capital versus market capital. This is going to help one make any kind of investment decision or understand the investment decision that are made on their behalf or that they ask an investment advisor to make for them. So again, that's the essence of our show here, is to explain those financial concepts. And that's why I title this show Why the 4% Rule Could Be Failing You. With your help here, we explained it quite clearly so people could understand that it's not just about fitting in puzzle pieces. You got to understand where they should fit in, which
Right.
brings me to hopefully my last question. For someone who wants to achieve income independence, what are the first 3 steps you recommend they take? This could be for anyone, regardless of
Mhm.
where they are in their
Okay.
financial journey.
Okay. So income independence is the point in time where you have enough income and it's constantly being produced so that it doesn't matter to you whether the market goes up and down or interest rates go up and down. Your income is secure and possibly and hopefully growing every year. It's what
Mm-hmm.
I think of as income independence.
Independence, yeah.
So, 3 things that you should do to help you get there. And can I talk about the person who is starting a portfolio? They either have a startup portfolio or they're thinking of starting a portfolio. The first thing you have to do is you have to go to the advisor, or if you do it yourself, start with an income focused direction. I want to buy things that pay me income so that my portfolio will constantly be working to produce capital for me. Okay.
Mhm.
So that's the first thing. Along with that is that the money you are putting into this thing, you don't plan on taking it out for your next shopping spree or to buy somebody a present or anything. This is money you're putting away for your future.
Mhm.
That's going to it's going to let you do what I did when I was 34. It's going to say, I've got enough money that I can quit this job and start my own business or start a new career because I have that much income coming in. That's where you want to be. And if you can do it by the time you're 34, then you could probably do it several times in your career, right?
Yep.
Okay. So that's the first thing. So you're going to do it yourself or you're going to tell your advisor, ma'am, I want the portfolio I want my portfolio to generate me more than 6% in realized income. And I want you to take profits that produce me at least as much as the fee that I am paying you.
Oh, yeah.
Tho-
Expense
Those
ratio is key.
that's a requirement. If
Yeah,
you are not willing to do that, then I'm going to have to look for someone else.
yeah, yeah.
Those two things. Okay.
Good,
Okay.
good.
Then you're trucking along and you've got this portfolio started, and then you're going to say totally in income based securities, and now I've got five figures here, getting close to six figures, and I'm still in my ute,
Yeah,
and I think I can afford to branch out a little bit and have some stock market investing in
right.
within my portfolio. I'm going to tell my advisor, thank you, you've helped me. I'm generating nice income over here, but now I want to start also participating in the growth of the economy through stock market investing. But I'm giving you the same parameters, pal. I want you to invest in stock market securities that are paying me over 5%. And I want you to generate for me capital gains and probably more capital gains than you were with my income
Yep.
producing. And of
Hmm.
course, underneath, I'm talking about closed end funds because you can do all these things with closed end funds very easily with any size portfolio. The problem is finding an investment advisor who knows what they are.
Exactly. Go ahead, sorry.
And then, if, of course, the third thing is when you get to that point, that aha moment where you say, okay, look at this. Look at this. I'm breezing along. I'm making how much do people make these days? $50,000
For what?
for a year for a job? I don't know
No, no, no,
for
no,
an
no.
exec for that's not a startup. Well, I
Oh,
don't
no.
even know.
You won't be able to eat. Do you go to the grocery store at all?
All right, okay. I'm making $100,000.
At least, yeah.
I'm breezing along with $100,000 on my salary. I'm getting a nice bonus and stuff like that. I think I'm ready to look to start my own business because they're doing some stuff that I would do a little differently, and I think I can make that happen. And I've got contacts all over the world, and so I've got this portfolio over here that's generating me a little even more than I'm making because I suck this money away. I can afford to say goodbye and start my own business. Or later on, you get to that moment where you say, I can afford to retire early and see the world.
Yeah,
Say,
that's really the
so
get
those
your
are
money
the,
to work for you. Yeah.
yeah, so that's where you want to go with. I think you might not realize it right now, but eventually you're going to want to see the world. Uh,
I think that with technology and everything that we have that allows us to see what's happening in places that we couldn't see before is really getting people to say, I want to go, I want to have that experience. So we're talking about a new generation that they are more into experiences than anything else.
My granddaughter's been to 26 different countries already,
Yeah.
and
And
she's just graduating college now.
yeah, and I'm not at all surprised because that's where it's at. The images are there and people want to experience them.
Right. And it
So but you have to be able to do it. And the only way that you could do that is
is
by
to
preparing yourself
preparing
early
yourself.
when it comes to your personal finance.
Right.
So,
And you,
as we wrap up today's enlightening conversation with Steve, I want to thank you, Steve, for sharing your wealth of knowledge with our audience. Okay, you've given us a fresh perspective on retirement planning by highlighting the four great financial risk minimizers. And I certainly hope that the audience will go back and listen to it again because these are very basic principles that anybody who wants to invest should be adhering to. Okay, this can protect our financial future, explaining how managing a portfolio is similar to running a department store where diversification and inventory management are key. Okay, you've emphasized that the true goal of income independence is creating a reliable stream of income without selling your investments. And what really resonates most with me is your focus on shifting from worrying about market fluctuations to building a system that deliver consistent income regardless of the market conditions. This approach certainly offers peace of mind that many retirees are seeking in today's volatile economic environment. Your insight reminds us that retirement planning is not just about accumulating wealth, it's about creating a sustainable income strategy that supports our lifestyle goals while minimizing risks. I would tell my audience that if they found value in today's discussion, here are a few ways to take action. Okay, first, grab a copy of Steve's best-selling book. In fact, let me run a banner with your information here so they could see it.
You do this too.
Yeah, so grab a copy of Steve's best-selling book, Retirement Money Secrets, which dives deeper into the strategies we discussed today. Second, join the RMS, Retirement Money Secret Income Investing Community online, okay, where you can continue learning about income-focused investing approaches that Steve teaches. And third, make sure to share this episode with someone you know who is concerned about their retirement income security. This conversation might just change their perspective on retirement planning. And finally, subscribe to our podcast to continue receiving valuable insight on merging life and money effectively. Steve, our listeners have heard your valuable insights today, and I am sure many of them would like to learn more about your approach or potentially even work with you. So, for those interested in engaging your services or learning more about income independence, what's the best way for them to reach out to you or access your resources? I do have a banner at the bottom.
Yeah, I was just reading
Yeah.
it. The easiest way really is in the book. All my contact information is there, so that's the one thing. And of course, we'll be able to accomplish more in a conversation if you have read the book than if you
Mhm.
haven't. But I do have my business website is coach.net, and you can reach me through that avenue as well.
Great. Thank you so much for listening to the Merging Life and Money Show. Thank you, Steve, again for such great insights. I am your host, MarieJo Caesar. I will see you next week. Until then, continue merging life and money. Bye for now. Hi there. Thank you so much for watching. If you enjoy watching this video, I know you will love this one. Stay here and check it out.